having been completely wrong about really everything, but really everything, with his abstruse theories about the depression and the current conditions, for sure I would resign. But if I were, say, a pension fund, I would tell the contributors and the recipients, either you pay more or you receive less. But we have to balance the books, because the returns aren't going to be the ones that we are used to between 1982, when the Dow Jones bottomed out below 800 and subsequently rose to over 14,000. It's not going to happen again in real terms. Maybe if they print money. But if they print money, as I said, the purchasing power of the, say, average American household will diminish, because his cost of living will increase that much more.
Oh, absolutely. And I want to just back up for 1 second and note that I should be more careful. You're right. The money printing has had effects, of course. And my point back there was just that money printing today is not having the impact it had in the past. 10 trillion dumped into the markets in 1990 would have been a very different circumstance than what we're seeing today. And we're seeing a lot of loss of traction today. I'm wondering, from my vantage point, I note that there's never been a global recovery with oil prices, even at an inflation-adjusted level, at the current levels they're at. Do you see these high energy prices, particularly for petroleum, are these a contributing factor in this loss of traction, or is this just because is the loss of traction simply we have too much debt in the system and that's the main factor here?
I think you're asking a very important question. Traditionally, oil prices around this level have been negative for economic growth around the world, whereby we have to distinguish. Say, in 1998, when oil prices bottomed out at $10 a barrel, the income from oil or the expenditures for oil were around $400 billion.
Mm-hmm.
Now, at the current price, they are around $4 trillion. In other words, some people get the $4 trillion, the people that produce the oil, the Emirates, Saudi Arabia, Russia, Venezuela, Ecuador, Angola, Nigeria, and so forth. And on the other hand, the people that use the oil, the US and Western Europe, they pay a higher price. So for some people, it's a revenue, and for people, it's a expenditure. The people that have to spend it on, unless they can borrow more and more as they have in the past, they can roll it over. In other words, it's not damaging.
Mm-hmm.
But the people that can't borrow money to pay for the increased price in the oil, in other words, like an increased tax, they suffer. So they have less to spend. And that's why I think the economy in the Western world will be relatively sluggish. I think we've bottomed out in the U.S., but it will remain relatively sluggish. But mind you, say anything happens in the Middle East, and the price of oil goes from, say, the current level of $110 or $100 to $150 or $200. What do you think Uncle Ben will do? Uncle Ben, he knows only one thing, and this is to print money.
Indeed.
And so he will print money, and as a result of the money printing, the oil price may, following a crisis, go down somewhat, but it's not going to go down to $30. It will stabilize at, say, $100, and the economy will be sluggish, and so he will need to print more money. Because what else does he know? He knows nothing.
Well, and as you noted before, when he prints money, he hands it out and it goes sort of disequally across the society, with the printing very much not ending up in the lower middle class hands at all. So those rising oil prices are just going to continue to exacerbate. We'll have the wealth inequality issues. We'll have rising levels of food stamp usage, and the bottom really gets taken to the cleaners in this printing effort. And what I'm seeing here is this really large structural problem where originally we had too much debt, and now we might have too little oil, because the oil markets are actually pretty tight right now. And that's a structural, maybe a geological problem, and so you can't print oil, but we're going to do what we know how to do, which is print. So these two great forces are coming together. A historical tendency to print, which goes back, I believe, to Roman times in their own way of printing. But so we have this desire to print. That's how we get through these things. And then on the other hand, we have these rising oil prices, and that creates a structural imbalance. We're going to have more and more money going into the system, which brings me to a very important question, which is that you're a big proponent of holding precious metals, as am I. They've done quite well over the years. You've been advocating for them. They seem somewhat range-bound in recent months. Where do you see precious metals fitting into this story now and, say, for the rest of the year?
Well, I think that every person should own some precious metals as a reserve and as an insurance policy against a complete meltdown in the financial system. And as you know, we had MF Global. What did the clients get? Less than what they had in the company. And I think eventually the financial system will be an MF Global, where you don't get your money back from the banks and the investment banks and from the mutual funds and so forth and so on. And so I think everybody has to think himself, how do I protect myself against such a black swan event? Now you have say a life insurance policy and you have a health insurance policy. If you have a health insurance policy and a life insurance policy, you're not exactly hoping to die and have an accident. But if it happens, you have it. And so I would suggest that people own some precious metals. And I think, say, the prices, they've gone up a lot since the lows in 1998, 1999. But compared to the expansion of credit in the world, compared to the expansion of wealth in the world and money printing, I don't think that gold is terribly expensive. Having said that, I think we reached a peak at 1,921 on September 6th of last year. We mailed the low at 1,522 on December 29th of 2011. We rallied again. I think we're still in a correction period. But I'm not going to sell my gold when I see people like Obama running America, and possibly they'll have a Republican after 2013. But I don't think the Republicans will be much better. So I want to own some gold. And as I told you, I think the money printing will go on. Unless the Fed would come up and say, we're no longer going to print any money, the monetary base will remain steady. And even in that case, I wouldn't believe them.
Well, you mentioned something very important in there, which is MF Global, and I had a very instructive learning out of that. I actually got caught up in that. I had $50 in an account, so I'm actually part of the class action. That's a fun little fact there. I was keeping a placeholder account open at Linda Waldock. But at any rate, what I saw in the MF Global situation was that people who had fully allocated numbered bars in their accounts at Comex had those taken as part of the trustee process, sold out and put into a general pool, and then they were distributed back, which is kind of like, to me, if it feels like you parked your car in a garage that went bankrupt and they seized your car, sold it, and gave you some money back for it. To me, that was a very instructive lesson that where you hold your gold seems to be incredibly important. So when you advocate holding gold, I assume it's not in a place like MF Global. How would you advocate people do that in the safest possible way, given our learnings from MF Global?
This is a very good question. Where is anything safe? I mean, I think in a safe deposit box, it's relatively safe, but maybe not in a safe deposit box in the U.S. Because if you look at the MS Global case, it seems, and I don't know for sure, but it seems that some people got their money, but not others. This is a very disturbing thing to happen in a financial system. And when I see this, I think we have to be very prudent. So I would hold, say, a safe deposit box outside the U.S. Now the question is, how is it to hold a safe deposit box with a bank if the bank closes down and this and that? You can also hold safe deposit boxes in duty-free stores, warehouses at airports around the world. In Switzerland we have them, in Singapore we have them, and so forth. So that's a possibility.
Mm-hmm. Okay, and in part you mentioned that this would be insurance against the possibility of a systemic crisis. We had, allegedly, we came within hours of a really bad meltdown in 2008 if Mervyn King and Hank Paulson, then Treasury Secretary, are to be believed. It was a pretty dire moment. I look at where we are today, and I notice that derivatives happen to be a little over $100 trillion higher than they were in 2008, and the imbalances at the sovereign debt level seem to have grown much larger. So I'm seeing that the basic, let's say, pressures on the system that were in play in 2008 all still seem to be in place, in fact, maybe larger in many cases. This systemic crisis you're talking about, would this be something like we had in 2008, where it was literally the potential meltdown of the banking system itself? Or are you thinking of something that would result in capital controls being imposed so that certain regions could be fireboxed off from other regions? What are you talking about when you use the term systemic crisis?
Well, I think that if you look at the history of crises in the last, say, 30 years, each one was greater and larger. And we had the Nasdaq going down, so they printed money and so forth. What did they produce? The housing bubble and an even worse crisis and so forth, and the financial crisis. And now they essentially didn't solve the problems, but they alleviated the symptoms of the problems. And I think the next crisis will be much worse. But the question is, as I said earlier, how do you protect yourself in the next crisis? Do you own equities, sovereign bonds, cash, commodities, gold, precious metals, and so forth? And my view is that you're probably better off in precious metals and in equities than in cash and in bonds. And I also happen to believe that in some parts of the U.S., notably the South, Phoenix, Atlanta, Las Vegas, and so forth, real estate prices are bottoming out. Now, can they drop another 10%? Yeah, sure. But another drop of 10% is not the end of the world when you consider that most individuals were in the Nasdaq in 2000 and then it dropped 70%. So I'm not saying that real estate will go up substantially. I'm just saying now you can buy real estate in the south of the U.S. at, say, 30 to 40% discount to the construction cost. So I think it's reasonably priced. I don't think it's, actually I think on global standards it's relatively cheap. But my wider view is